Good evening, everybody. Good evening. Very polite. I'm going to do the first half of the presentation, and then when it gets complicated, my finance director, Nick Wong, will take over. Some of you were here last year, and we've opened a few more restaurants since then. We're now at 69. We've just signed a site in Glasgow, which will be number 70 for another pizzeria. You must read this very carefully. Anything I say does not encourage you to buy shares. I think that's what it says. And so we founded Fulham Shore in 2012. Most of the team is extremely experienced in running restaurants. I've been doing it for over 40 years. Nick is relatively new, 14 years. And we currently have 51 Franco Manca trading and 18 the Real Greek. Who's been to a Real Greek? Hands up. Oh, thank you very much. Some. Who's been to Franco Manca? Oh, more. That's probably because we've got more of them. Thank you very much. Both of the businesses we own, we only own two businesses, are very good value, under somewhere between £9 and £18 a head, which we think is a sweet spot that will not defy any downturn in economy, but will be better positioned in a downturn in the economy. We think if you have a business where it's £150 a head, whatever you're serving, you could probably only open 5 if you're very lucky in the UK. But market penetration is obviously a hell of a lot more if you are at £10 a head or £15 a head. There's an appendix in the end about all the people we employ. And we have grown both turnover and profits every half year since we floated in the end of 2014. So just over 5 years. And this has obviously been driven by the number of restaurants we've opened. We bought the Real Greek at the end of 2014, and then we bought Franco Manca when it was 11 stores in spring 2015. And as I say, we now have 51 Franco Manca from 11 when we bought it. We now have 18 Real Greek from 6 when we bought it. We've just opened a Real Greek across the river from here in Bridgemaster's house, underneath or within Tower Bridge. So it was the old yard, and as it says, the Bridgemaster who controlled the levering up so the ships could go underneath. And that started off very well. But our idea in the early 2012, 13, 14 was to find businesses that we could grow quickly, that was of really good value for the customers. And we also specifically didn't want to build a chain, although we've ended up with a chain. But we didn't want to have the mentality of a chain, because customers quickly work out you're just selling the same product in each part of this, what we call a necklace. And so in Franco Manca, for instance, each branch makes its own dough, which gives them the responsibility that anything goes wrong, it's their problem in the branch, and it's their fault, and it's their stupidity. Or, if they have lots of customers, they get the praise, because they're very proud of their one store. And the same with the Greek. They do all the cooking in store. There's no sort of boil in the bag process. So each restaurant is proud of its own entity. We keep our prices low, so profits are not only shared with the hopefully rise in the share price because of increasing profits, but we also have lots of profit share schemes and bonuses within the business. And we will, when we are creating surplus cash, we will consider a dividend policy, probably at the end of this year. So Franco Manca, for the 15 people in the audience who've been there. It was founded in 2008. We only sell 7 pizzas and a couple of specials. We don't do pasta. We don't do grills. We have a extremely limited menu, which sometimes puts people off, if they don't have a choice. But we also like to think that if you're going to do something well, you might as well just do one thing and then you actually get it right. It's easier to do a mixed menu. You get more volume. However, we think because of our low prices and our concentration on one product, we are selling the best pizza you can buy. And so our average customer volume in each restaurant is about 2,100 people a week, which is far in excess of people like Pizza Express. Their average customer numbers per site is about 1,300 a week. Our prices are lower, so you would think that our margins are lower, but in fact, because of our higher volumes, actually we make more money than other people because our restaurants are very, very busy. Another thing we do with the restaurants is we don't make them too big. Back in the day when we were involved in Pizza Express, the tipping point came in West End Lane, Hampstead, where we kept getting bigger and bigger restaurants, paying more and more rent. And the clue is that one of the Pizza Express is now Waitrose. So you can see how far ahead of ourselves in terms of size. And so if you get smaller restaurants, you fill them with lots of customers, you get a great atmosphere, and of course the rents are lower. 2/3 of our openings over the last 12 months since I was last here have been outside London. For the first time, we've really gone into the, as a Londoner, be careful what I say, other parts of the country. Manchester, Leeds, Edinburgh, Southwest. I'm from Southwest London. I think the rest of London's pretty weird. So, London stores do really well, but if you're establishing a national brand, you've really got to, start by going into the cities around the UK. As I say, we've just signed in Glasgow, so that'll be our second in Scotland. Manchester and Birmingham have gone into the top 10 restaurants we have in Franco Manca and trading really well. We have told the city we're going to do between 8 and 10 again this year, Franco Manca, in the UK, and possibly open abroad for the first time. Well, sorry, we're already open abroad in Franco Manca. We've got a franchise in Italy, which we open in the summer, which is very successful. The Real Greek, we have 18 now, and the Real Greek actually takes more money per store, makes more money per store on average than Franco Manca, because the Greeks are maybe 40% bigger. They cost more money to develop, though. So the return on capital is about the same. The return on capital is above 25% in our business, and we intend to keep it like that. That's a prime consideration when we approve a site. It's got to have 25% return on capital straight away. The Real Greek menu lends itself to the current trend in healthy eating. The Greek diet is vegetarian orientated, and we launched a vegan menu 18 months ago, nearly 2 years ago. And we're going to look for more sites. As I said before, we push some of the profit back into incentivizing the workforce, because the quality of the food is only half the issue. It's the people who work for you who are the other half. And we need to pinch the best people in the industry from other people by paying them more and incentivizing them more. We have bonus plans. 50% of the employees are shareholders through either options or we gifted some shares to the staff when we floated. And Mr. Wong now is going to come up and talk about the eating out market in general, and I'll join him for the last couple of slides.
Thank you, David. So this evening I'm going to talk to you about the eating out market and then on to the finances in a second. Mintel is one of the sort of reports that cover our sector very well. What we've found is, and I'm sure you've read in the press, our casual dining sector has shrunk in terms of number of restaurants in the UK. But actually in the pizza and Italian market, actually that's continued to forecast to grow. It's the largest segment of the eating out market right now. And Mintel still believes that the whole market will grow about £0.5 billion in turnover over the next 5 years. We are very glad that we've started to be recognized by this publication. For the first time, we are seen as sort of bucking the trend with the Franco Manca brand, and we've got to a certain size now to warrant sort of coverage in the report. What's quite interesting is the healthy eating segment now is very, very popular. Whereas January was of veganism or, particularly for us, the sourdough pizza. Sourdough traditionally has been seen as a slightly healthier alternative to the traditional pizzas because it's done with the mother dough rather than the addition of yeast into the product. And it's good to see that 40% of consumers now are starting to recognize that. And I think there's a long way to go for us to push the sourdough pizza across the UK. What's also been interesting is for us, even whether it's in our segment or actually in the wider casual dining sector, a lot of our consumers are telling us that they would very much like us to concentrate on the dine-in experience. There's a lot of talk about delivery, and we are using delivery ourselves. We deliver with Uber Eats in both our businesses, but it is not a core revenue stream for us at this point. We are focusing very much on the dining-in experience in the restaurant. Some other sort of little snippets. 71% of consumers now are concentrating on ethical practices, whether it is environmental, like taking out plastic straws, packaging, etc. A lot of that is now very high up on the agenda, and for us, we are actually now revisiting all our packaging again, even though we did that a couple of years ago. We're doing it again to see how we can make that more eco-friendly going forward. So now I cover off results. The last set of results that we presented to the market was back in December for a half year, and there's a reason why I'm here tonight. The reason is we've adopted lease accounting for the first time this year, and that substantially changes how we report our numbers. So I would be very glad to tell you that our EBITDA has almost doubled, but actually a lot of that is to do with lease accounting. So that's why I'm here to explain what's actually changed. So our revenue grew half year to half year, 9.3%, mainly from new openings that we've opened, plus growth in our various restaurants. When you strip out the adjustments that we have made in order to comply to the new accounting rules, actually our EBITDA grew 10%. And so that's really in line with how our revenue has been growing over those 6 months. We've generated from the business, if we do it the old way before this lease accounting rules come in, we generated £6 million of operating cash flow compared to the previous year, just shy of £5 million. And using that, we have funded our openings. What we said to the market is that since the uncertainty of Brexit, which hopefully we're now going to see the certainty now, we would fund all our openings using existing cash flow, and where we can, start paying down some of the debt to de-risk the business. So we've also shown in this period, we've brought the debt down over the 6 months from £9.4 million net debt at year end to £8.8 million at the half year. So we're delivering on what we said we'd do. In the meantime, we did open 6 new Franco Mancas and 1 Real Greek. Since September, a half year, we've opened 1 more Franco Manca in Bishopsgate and 1 Real Greek in Tower Bridge, as David's mentioned. One very exciting piece of investment we've done is on our loyalty program, which I'll come on to later on. Now for the exciting thing about lease accounting.
I'll tell you when to clap.
I hope I don't lose some of you. Or wake up, yeah, exactly. So what's changed is we have to recognize all of our leases on our balance sheet now. Historically, we've treated them as operating leases, so we pay the rent, we recognize it in the P&L, nice and easy. Now, our typical lease is between 15 and 25 years. So now we're having to recognize that liability and the asset of that on our balance sheet. So as at April 2019, we've had to put onto our balance sheet rights of use asset of £64 million and a associated lease liability of 63.4. So it's a significant number compared to what we were used to report, and now is on the balance sheet. What that does to our P&L and to our balance sheet is that we now recognize depreciation rather than recognizing the rent, and we also recognize a notional interest charge. Nothing's actually changed. We still pay rent to our landlords. Nothing has changed there. We don't actually pay the interest, but in terms of the new rules, that's the way that we are recognizing it now. We are not allowed to restate our historic numbers, so that's why you see this year against last year is not really comparable. Hence, we've had to do the table in the previous page. However, the biggest issue with this accounting is in the early years of adopting this, because we're recognizing the full asset, our profits will always look a little bit lower at PBT level than the old way of accounting. Because obviously we've got the whole asset there and the whole liability. So obviously the interest is higher, depreciation is higher from day one. However, as we go through those 15 years, they swing the other way, and actually we're better off later on, probably about 7 or 8 years down the line, the numbers will flip the other way. So that is lease accounting. On our bank facilities, we do have a £15 million facility from HSBC that runs to March 2021. We have a margin over LIBOR of 1.5% to 2.5%. We're on the low end of that ratchet. And we have a number of covenants. What's interesting is even though we've changed the lease accounting rules, the bank has always looked at our leases as being on balance sheet anyway. So there's a fixed charge cover they've always looked at. That hasn't changed. We've got headroom on all of these areas. And actually, our debt to EBITDA multiple now is about 1 times. So we said that we wanted to bring it down to about 1 times just to de-risk this business, and that's where we're going to try and keep that. And we'll continue to fund that opening from operating cash flow, and we'll see whether we can continue to bring down the debt level over the next year or so. On to our investment this year. The previous year, we slowed down the openings because of uncertainties on Brexit. So we only opened 4 restaurants up till March 2019. In that time, that allowed us to focus on what we needed to do and invest in to safeguard the revenue stream for our business. And so we invested in a new CRM program. So what that does is to bring all the customer data historically that we've have and ongoing data into one place. So a lot of people use the term big data. Now, we use the term single customer view. It allows us to link in all the various sources, whether it's bookings, whether it's Wi-Fi usage, etc. We can track what our customers are doing, which gives us a more robust scientific understanding.
With their agreement.
With their agreement, of course. And GDPR is one of the things that we have to deploy this year. So I think what it does is give us a much richer understanding of what the customer is doing, have been doing, and what they would like us to do for them as well. Historically, in the restaurant business, we've always relied on our restaurant managers to get to know our locals. And when we're now into the sort of 70, 80 restaurants, it's very hard for our restaurant managers to keep track. And what's quite interesting is with what's happened in the last 2 years on employment, staff turnover has increased over time. And for us, that meant we need to help our staff understand our customers better because there's no longer that longevity of staff being in the restaurant. So we've built this. We've integrated our feedback system into this, so we're now able to get a lot of our reputational scores from online. So if any of you feedback on Google, if you feedback on TripAdvisor, all of those scores now come into one place. So we can understand, we can monitor our restaurants a lot better than we used to be able to do. And all of that comes from what customers are telling us from this feedback, because every single snippet of information helps us to understand, is there a particular problem in the site, or is there something a customer would like to from us? So on top of that, we launched a new loyalty program for Franco Manca. And this is a test bed, and if this works, we'll deploy this in the Real Greek as well. The idea for this loyalty program is very simple. So you'll see on the screen there is a 6 stamp card on a phone, on an app. And as we put this on, it only takes the customer 6 visits to earn 1 free pizza. And that will give us a lot more richer information going forward. This will set us up for the next 2 years to safeguard our revenue streams. Yeah. Yes. So I'll hand over to David to sum up.
You've got to come back here just in case they ask me any difficult questions. So we've grown profits, number of restaurants, every 6 months since we floated. Every restaurant makes money. We have currently 69 restaurants. As I say, we've signed Glasgow. We're looking not only for more sites in London, but also outside London. As Nick said, we've launched a loyalty program in Franco Manca, and we're offering somewhere warm and cosy with welcoming staff, and the food's great, and the prices are really low. So anybody got any questions? Yes, in the back.
Thank you for that. I've got 2 questions, if I may. From what you say, the choice of manager is really important as the location. Can you tell us a little bit about how you recruit your managers and what the structure is in terms of the franchise? Is it just one independent manager, or does he, in between the board and the individual
between the board and the customer?
Between the manager of the restaurant and the board.
The crucial link is between the board and the customer, really. Me and Nick and the customer. And you've got an MD who runs the business. You've then got area managers that perhaps run anywhere between 5 and 8. We think other businesses employ them to run 12, and we think that's too many. They can't concentrate to support the manager of the particular store. You then got one store manager and probably a couple of assistants, especially in a busy restaurant.
So how do you recruit that store manager?
I started as a dishwasher, and I ended up as chairman of Pizza Express, and that's the best way, because then you know all the jobs. And so if the dishwasher doesn't turn up, you can operate the machine, if you're chairman. But Nick touched on it, retaining staff. I mean, it's become... Brexit was a shock, and staff sort of disappeared overnight. They've now come back, but they're staying in the UK for longer. Franco Manca is 80% Italian, and the Greek is 60% Greek. So we rely on them coming to the UK, wanting to work hard, and knowing their own culture, for a start. But secondly, wanting a career path. And so we would encourage people, whether they come off the boat from Naples, to do what I did and work their way through the ranks. Now, we occasionally, maybe 25% of the time, need an influx of new blood. So we pinch people from restaurants that have gone bad, like Carluccio's or Byron, and we pinch the best people. But because, to cut the story short, we've been involved in restaurants in London for 40 years, and we know the best people who used to work for Pizza Express. We were then running Gourmet Burger Kitchen. So every time we've moved, we've sort of taken the best managers with us, paid them more money, and we know that they're honest and they work really hard. So we sort of know the best people to employ in London. And when you go to the provinces, it's a bit different, and it's a bit suck it and see, but usually we put an experienced manager we know, and we put them in Manchester, say, for a year. Does that answer the question?
Yes, but if I might just follow up on it. You said that they do their own dough and that sort of thing. What's the balance in terms of alcohol between, in terms of the profit, between food and alcohol? And also, do they choose their own wines or...?
No, we have guest wine sometimes, but the menu is pretty simple and pretty standard. They source their own product locally, vegetables and things like that. But the menu is very standard. We have 120 guest pizzas that they can choose from. But all those 120 recipes have to be agreed between the two chief pizziolas, and the chefs have to be trained on all 120. And then a branch can choose one of the 120 every day. And so you might get 4 branches that actually have chosen and bought locally a special. And it just happens to be that 4 of them have chosen the special that day. And we sort of don't know until they've put it in the computer in the morning. And so we see it, what they've chosen on the special board. So there's, say, 80% central control, but then 20% they can choose themselves about ingredients and things.
Thank you. Are you a franchise? And if so, how much control do you have over your standards? Do you make any surreptitious visits to see what the standards are in keeping with your ambitions?
No, we don't franchise. And it's the area manager's job to make sure that the number of restaurants in their area conform to the company rules.
Yeah, you're going to say you're going to open, I don't know how many.
8 to 10 restaurants this year.
And how long is the lease? And can you say or dictate the term of the lease?
Yes,
So
you can try.
To get
Yeah.
your
Every lease is different, and a question of negotiation. I forgot to say that Franco Manca costs £650,000 to open. When I said the return on capital is 25%, 30%, it costs 650 to open a Franco Manca on average, and about 750 to open a group. Tower Bridge cost us about 900 because it was a big store and it was a Grade 1 listed building. No, every lease is different. It's usually at least 15 years, possibly 20, 25. Every rent is different, and obviously we try and get the rent as low as we possibly can. We're negotiating, for instance, in Finsbury Park, and it'll be about £55,000 a year, which should be about 8%, 7 or 8% of our turnover in that particular store.
Do you have a target for market share in the UK?
No. Lots. No. Well, we went round at Pizza Express and said 120, and then we got to about 150 before we noticed it. Actually, serious answer, market penetration at McDonald's is at £4 or £5 a head is probably 1,500 in the UK. Depends on price, obviously, and product. In my day at Pizza Express, we targeted 300 or 400 at 13 or 14 pounds a head. You wouldn't be able to. They've gone to 450, and part of their problems are they've got too many, because the whole market has changed. Old high streets have been decimated. So you go to a high street where you could have opened 25 years ago and made a little bit of money. You can't do that anymore, and they've still got stores there that they're paying rent on. So if you were going to go out and open a Pizza Express today at 13 or 14 pounds a head, you'd probably say maximum 280 stores in the UK, and they've got 450, and that's part of their problem. So we're saying over 100, Franco Manca, 120 maybe. When we get to 120, it might be a bit more.
Do you know this setup in Red Lion Street, Richmond?
Yes, intimately.
I'm wondering if you're taking any business off Pizza Express, the big restaurant exactly opposite your restaurant there.
Yeah, we're paying a third of the rent. We've agreed 100 grand for 10 years, including the basement, which was thrown in for free, and they're paying about 240 grand for their unit. So our business model is better there. They're still very busy, and we're busy. So there's sort of slightly different concepts these days. They've got a much bigger menu. Their product is rubbish. Am I allowed to say that? Sorry. No, this side has asked no questions apart from this chap. Come on.
One more.
Yes, sir.
Just a quick one with here. You said that the priority was debt reduction, but also you have to incentivise the staff. when will the shareholder get their
But also, is there an opportunity?
Well, we have
No,
said.
1 second. Is there an opportunity for not just getting appropriate dividend, but also to get a free pizza? Thank you.
I think the word free and Mr. Wong don't usually appear in the same sentence. But,
Come 6 times, you get one free.
yeah. Download the app and you get one for free, yeah. Good answer, Mr. Wong. Thank you very much. That's why I brought him along. Anybody else? No, that's okay. Thank you very much.
We better wrap up there.
Yeah,
David,
thank you.
Nick, thanks very much indeed. Thank you.